Good morning, accounting 230, 40998. This morning, the subject is chapter 9. It's all about fixed assets. So I'm going to wait a moment here and see if we get anybody to actually come to the class. I know it's optional. We'll see if anybody took the option of showing up. Let me get my PowerPoint set up here. Okay, put this over here. Okay, chapter 9, recording and analyzing long-lived assets. Oh, hi, Derek. How you doing, Derek? Are you there?
Yeah, can you hear me right now?
I'm just having trouble hearing you. You're a lot of interference. Okay. All right. Well, chapter 9 it is, Derek. And thanks for contacting us about me getting a little screwed up with the schedule there. So anyway, hopefully we're back on gear here with chapter 9. Long-lived assets, fixed assets, property and equipment. We're going to talk about amortization of intangible assets and some other things. So there's quite a lot in this chapter. And the first learning objective, plant asset expenditures. Plant assets are resources that have physical substance or used in the operation of the business, not intended for sale. It's a piece of equipment, a fixed asset that's going to last a long time, and it's going to be depreciated, unlike land. Typically referred to as property, plant, and equipment, also called fixed assets. And they're just showing you fixed assets as a percentage of their total assets. And it's interesting, if you look at the bottom, Microsoft has very few fixed assets, which is understandable. I mean, that's a computer programming place. Most of their assets would be in the intangible world of programming. Wendy's has a lot of fixed assets, which makes sense. They have a lot of ovens and broilers and cooking vessels. Valuing plant assets. Everything on your balance sheet is going to be at the historical cost. Requires that companies record plant assets at cost. Once you record it at cost, you're never going to credit it, never again. The cost consists of not just the price of the equipment, but all the ancillary costs involved with it, such as it could be insurance or installation or something like that. So the cost of all expenditures necessary to acquire an asset and make it ready for intended use, measured by cash, of course. Capital and revenue expenditures. Cost of land. Land might cost you $1 million, but there are a lot of other costs that get piled on top of that. And that's the point they're trying to make here. You buy land for $1 million, you're going to have a title search. There'll be attorney's fees. There'll be real estate brokers. You're going to have to pick up the property taxes that are due at that exact point in time, any liens on the property. All that might add up not to $1 million, which is just the land, but it might be $1.3 million, in which case you would debit land for the $1.3 million. And here's an example. Hayes Company acquires real estate for $100,000. The property contains an old warehouse that is raised at a cost of $6,000, $7,500 in cost, but they managed to get $1,500 back in salvage. There were additional expenditures, and you had a real estate broker's commission. So you're going to have to take that 100,000 plus the 6, plus the 1, plus the 8, and the cost of that land has become $115,000. So the cost of any fixed asset will also include the other costs related getting the asset into service. Land is a good example because there's automatically a whole bunch of them. Cost of land improvement, same thing, includes all expenditures necessary. Land improvement will have a limited useful life, and we're going to depreciate it. Driveways, parking lots, fences, things like that are called land improvements. Land, Derek, is never, ever depreciated. Land improvements are. Now we're talking about a building. Include all costs related directly to purchase or construction. Purchase costs, the purchase price, the closing cost, attorney fees. You get the idea. There's always extra costs involved. Remodeling or replacing or repairing the roof, floors, wiring. Where I worked many years ago, we bought a big machine. We had to knock down part of the wall to get it into the factory. And the cost of knocking that wall down and then repairing it afterwards, that became part of the cost of the printer itself. Costs of equipment include all costs incurred in acquiring the equipment and preparing it for use. And they're giving you some more examples. There's sales taxes, freight charges, insurance during transit if you have to pay for that. And another example, Leonard Company purchases a truck, price is $22,000, and you got sales tax. They wanted to paint and letter the truck with their company logo. They had to pay a license fee, and they bought an insurance policy, a 3-year accident insurance policy. That is a prepaid insurance policy. And the cost of that truck is $23,820. You don't include the insurance policy because that's a prepaid item. It's going to get expensed over the next 36 months. They purchased a delivery truck at a cash price of $22,000. And again, we have sales tax, lettering, and a 3-year $1,600 policy. This time they're putting the policy into the cost of the asset, which I really don't understand. That insurance policy I don't believe should be part of the original cost of the asset. I'm going to take this one up and do a little quick research for us, Derek, and and I'll get out an email to everybody on that because they're contradicting themselves there. Let's talk about different expenditures during the life of a fixed asset. We have what are called ordinary repairs as opposed to additions and improvements. And there's a big difference between the two, and we need to understand them. Ordinary repairs, expenditures to maintain the operating efficiency and life of the unit. It's debited as an expense. It's an expense, maintenance and repairs expense. An example would be you bought a new truck, and every 3,000 miles, you have to change the oil. Every year, maybe you have to change the brake fluid or something. That's normal repair and maintenance. All that's doing is keeping the truck within the confines of what it was intended to do in the first place. An addition and improvement would be if you took that truck and you tore the transmission out and you put in a whole new transmission and you removed the engine, you put in a big souped up engine and put big fat tires on it. That would be an addition and improvement, and that would be capitalized. Capitalized, meaning that would go on the balance sheet as a debit to the truck, and it would be depreciated over a period of time. So there's a difference between an ordinary repair, which is an expense, and an improvement. To buy or lease is always a decision companies are faced with. What is a lease? It's an agreement in which the owner of an asset allows another to use the asset for a period of time at an agreed price. Leasing has certain advantages, reduced risk of obsolescence. You can always turn in the asset for a more updated one. Usually no down payment. Then you have tax advantages. Your payments are going to be tax deductible to buy or to lease. Drummond Company purchases a delivery truck and incurs the cost below. Explain how the company should account for each of these costs, okay? The $600 insurance policy, let's see what they do with that. We know the others are included. Yep, now they're saying, now they're back to an operating expense. So what they're saying here is the sales tax and delivery costs and painting and lettering, those are all considered part of the cost of the truck because it sets the truck up the way you want it to be. That's the original cost of the truck, the invoice cost plus the sales tax, whatever it took to freight it in, and whatever you did to touch it up. The insurance policy is just an ordinary operating expense, and same thing for the $80 annual motor vehicle license. Applied depreciation methods. Let's go. We're going to talk about some depreciation methods. Depreciation, it's an estimate. It is a process of allocating to expense the cost of a plant asset over its useful life in a rational and systematic manner. Rational and systematic manner is a GAAP term. It's a process of cost allocation, not asset valuation. What they mean by that is the book value of a particular asset has nothing to do with its real market value, okay? We are not trying to revalue the asset. We're just allowed to take into consideration the wear and tear on the asset via depreciation expense. And we're going to depreciate land improvements, buildings, equipment, never land. You do not depreciate land. It's allocated and depreciable because the revenue producing ability of the asset declines. As an asset gets older, it doesn't work quite as well. It might slow down, and we want to recognize that impairment. Depreciation expense goes on the income statement. Accumulated depreciation reduces the plant assets. Accumulated depreciation reduces our assets because it is a contra asset account. It is contra building account, contra car, okay? Depreciation expense, that's $100 a month. The $100 credited to accumulated depreciation. The accumulated depreciation will rise and go up and up and up until it equals the original cost of the asset, and it's fully depreciated, the net book value being zero. Factors in computing depreciation. First of all, we have to know the cost. We have to know which costs are included in the new asset and which ones are considered expenses. Once we know that, we have to come up with an estimate. There's that word again, estimate of the expected life based on what this truck is going to do for us. And then when we have that, we have to estimate again a salvage value. We bought a truck, a big truck like that, and we said the truck is going to last us 10 years. We paid $100,000 for the truck that's going to last us 10 years. At the end of 10 years, we are estimating today that 10 years from now, someone would give us $500 to tow the truck away. A junkyard dealer would love to get his hands on an old beat up truck. Salvage value is an important concept because you do not depreciate the salvage value. The net book value of an asset can never go down below the salvage value. So salvage value comes into play in your depreciation calculations. Now we're going to go over three methods. Select the method that best measures an asset's contribution. Straight line, I guess what they're saying here is 83% of companies use straight line. Straight line is easy. It makes the expense the same every month. You buy an asset 20 years and you're depreciating it over 240 months. Well, every month that number is going to be the same. The declining balance method, get in the habit, Derek, of calling it double declining balance. Double declining balance, because it's simply double whatever the straight line rate would have been. And we're going to go over that in a little bit. Units of activity, that one you could use for a car. We're going to depreciate it based on how many miles were driven. how many stamps a machine made, okay? Bill's Pizzas bought a delivery truck and they had a salvage value of $1,000 and the original cost was 13. So we're only going to depreciate $12,000, right? What is the estimate in miles? Looks like they're going to compute depreciation using straight line, units of activity, and declining balance. We're going to go through all three examples. Straight line method. Paid $13,000 for the truck. Salvage value $1,000. We think someone's going to give us $1,000 when this thing is fully depreciated in 5 years. So we're depreciating $12,000 a year divided by 5 years. Every year, we're going to make the same journal entry. We're going to debit depreciation expense and we're going to credit accumulated depreciation. You never credit the original cost of the asset unless we're getting rid of it. You never credit the original cost of the asset unless we're getting rid of the asset, okay? And take a look at the computation. This is pretty basic. In the year 22, we have a 5-year life of the asset. 5 into 12,000 goes $2,400. So the expense every period is this amount. Every period, we're going to debit annual expense. I'm sorry, we would debit expense. We're going to debit depreciation expense, and we're going to credit accumulated depreciation for 2,400. The next year, debit expense for 2,400, debit accumulated depreciation, 2,400. The accumulated depreciation goes up every period until it equals the net book value, until it equals rather the original cost of the asset. And here's your journal entry. Debit depreciation expense, credit accumulated depreciation. If the truck was purchased on April 1st, well, that just means we have to prorate it by months for the first year. They bought it on April, so that's 9 months into the new year that we're going to have it. So you just take 9/12. The first year depreciation would be 1,800, and the last year would be 600. That's all they're saying, that you have to break it out by month. Straight line depreciation, do it. Do it. Mountain Ski Company purchased a new machine for $50,000, 10-year life with a $2,000 salvage value. So we're going to say 50,000 minus 2,000 salvage value equals 48,000 depreciable amount. That's the amount we're going to depreciate over 10 years. So that'd be $4,800 a year or $400 a month. Cost minus salvage value times the rate equals the annual expense. How'd they get the rate 10%? It's 10 years, 1/10. And there's your journal entry. Debiting depreciation expense, crediting accumulated depreciation. Now we get into the double declining balance method. Double declining balance. Double, that word's important. This is an accelerated method. What this is going to do is put a lot of depreciation expense in the first year or two, and then very little as years go on. Double declining balance rate is double the straight line rate, and the rate's applied to the book value. So let's see what we have here. Now, 2 things here with the double declining balance method. One, you ignore the salvage value, unlike on the other method. Unlike on straight line where we subtracted the salvage value, declining balance, double declining balance, you do include the salvage value in the original depreciable amount, but you can never go below the salvage value. So let's take a look. Our original asset, they're using 40% here. Okay, that means it's a 5-year deal. 2/5 is 40%. So before, okay, so they just came up with 40%. we're going to take 40% of 13,000, and that's going to give us 5,200. So that's a big, big chunk of depreciation expense in the first year. And the book value of the asset, 13,000 minus 5,200, goes all the way down to 7,800. Then the next year, we take the lower of book value multiplied by 40%, and we come up with 3,120, 7,800 minus 3,120 equals 4,680, etc. Now, when they got down here, the salvage value was $1,000, I would imagine. And what they're telling us, we cannot let that 680, we can only plug in the amount that gets us down to 12,000. If you multiply 1630.85 times 40%, you get 674. We need 685. Let me just move this here. We need to adjust to 685 to get to the 12,000. Okay? Double declining balance. It's double whatever the straight rate would have been. This was a 5-year asset. So 1/5 of that is 20%, times 2 is where they got the 40. Straight line times 2 is your double declining balance. Assume the truck was purchased on April 1st. Well, again, they're showing us this business where they bought the truck after 3 months. So the first year, only 9/12 of that, only 9 months worth of depreciation would be recorded in 2022. So it's 13,000 times 40% equals 5,200. But then we got to multiply that by 3/4 to get the first year's depreciation expense. And the last year would be whatever the number is necessary to come up to a salvage value of $1,000. Okay. Units of activity. Now, with this method, again, we are subtracting the salvage value. We are subtracting the salvage value. This is where a company estimates units of activity. And the easiest example I can give you is mileage. You buy a car and you say, we expect to get 100,000 miles out of this car. So every mile that is actually driven, it's going to cost you so much in depreciation expense. And the depreciation cost is cost less salvage value. So we have an item here. We bought something for 12,000 and it's going to give us 100,000 units of activity. That's 12 cents per unit of activity. Now they have to give you the actual numbers. The actual miles driven in 2022 was 15,000. The actual in the next year was 30, etc. You multiply it out and that becomes your depreciation expense. You debit depreciation expense and you credit accumulated depreciation. And so on and so forth until you get down and use up, until you get down to the book value of $1,000, okay? Here's our journal entry for the first year. And now they're just showing you comparison among the methods. Straight line, well, that makes everything easy. Oops. Straight line's easy because everything is the same. It's going to be $200 a month or $2,400 a year. Unit of activity is pretty easy because all you're doing is multiplying the units driven, the miles driven by the overhead rate. And here, I'm sorry, I keep hitting that button. And Jesus Christmas. And here, the declining balance in the middle, you front loaded a ton of depreciation. You've put well over half of it up in the first 2 years. And companies have the option to do that. And they're just showing you graphically the 3 methods. Straight line, of course, is a straight horizontal line. Units of activity goes up and down, and declining balance goes down as you get closer to the end. Depreciation and income tax. IRS does not require taxpayers to use the same depreciation method on the tax return. It requires either straight line or the modified cost recovery system, special accelerated depreciation method, not acceptable though under GAAP. So I don't think there's gonna be much in terms of questions and homework on that. And again, the disclosure, the notes of disclosure are so important. Southwest Airlines, here's what they're telling us. Depreciation is provided by straight line method to estimate its residual or salvage values over periods ranging from 23 to 25 years for flight equipment, meaning planes. Now, an asset can change in the middle of its life. It might be that we think the asset will last longer than we thought, or might have to be shortened. This is not a mistake. This is just a change in our thinking. So revising periodic depreciation accounted for in the period of change and future periods. It's considered to be a change in the estimate, and you don't go back to prior months and fix anything. You start anew with the calculation I'm about to show you. This is not an error. It's a change in our estimate of the machine. The machine might be doing a lot better than we thought. Engineers are looking at it, and the engineer says, you know something? This machine's not going to last 10 years. It's going to last 15 years. Well, we want to reflect that into our depreciation calculation. Arcadia purchased equipment for $510, estimated useful life of 10 years, salvage of 10,000, okay? And they've been recording depreciation for 7 years on a straight line basis. In 2022, that's year 8, the beginning of 2022, it determined that the total estimated life should be 15 years. Wow, this machine's doing better than we thought. What is the journal entry? Well, here's how we figure it out. At that point, there is no journal entry, but what we have to do is recalculate. So let's take a look. We had an original asset. We paid $510,000 for it. The salvage value is 10. We've been depreciating it for 7 years. 7 years, right? So the net book value has gone down to $160,000. You see that, Derek? We purchased the machine for $510,000. Salvage value was 10. So our depreciable base is $500,000. We're chewing that up at the rate of $50,000 a year. We did so for 7 years. So now at the time of the revision of the life, our net book value is $160,000. What we need to do now is this. We take the 160, we subtract the new salvage value, which they gave us on the prior slide. They told us the new salvage value. So there are now 8 years left in that machine. So the new depreciable base is 155 divided by the remaining 8 years, 19,375. Are you able to follow that, Derek? Okay.
Yeah, I don't know if you can hear me, but
Okay. And there's your journal entry for the next 8 years. You're going to debit depreciation expense and credit accumulated depreciation. Impairments. Now you have an asset, and now the asset is not doing its job, or it's an asset we don't need anymore because the market has changed and the product that this asset produces is not going to do us any good. We have to write down the asset to its new fair value. And that's an important concept where you always recognize losses. Revised depreciation. Chambers purchased a piece of equipment for $36,000, 6-year life, $6,000 salvage value. The straight line was $5,000 a year, right? 36 minus 6, that's 30,000 divided by 6. At the end of the year, it estimated the total life to be 10 years and a new salvage value of 2,000. So let's see what we have here. This is very, very similar to what we did a couple of slides ago. We are going to have to come up with the new net book value. The original cost of the asset was $36,000. We subtract 6, and we've been over the last 2 years depreciating this thing at $5,000 a year. So the net book value at the change of the asset is $36,000 minus the 10. Your net book value is $26,000. Now we have a new salvage value that they gave us and a new remaining years. In this case, it's 8 years, $3,000 a year. These problems can be a little bit tricky. The key thing to remember is make sure you get the net book value at the time of the change in estimate. And then from there, it's just a matter of applying the new salvage value and dividing by the new years, okay? And they're finishing it up here with the journal entry. 26,000 minus 2 is 24, divided by 8 is 3,000 per year. Here we go. Explain how to account for assets being disposed, disposal of planned assets, okay? We can sell an asset to somebody else to get rid of it. We can retire the asset's no good, we're just throwing it away. Or maybe we can exchange it for another asset with another company. Maybe we can trade a truck. Maybe we can trade a truck for a couple of cars or something. Record the accounting for disposals. Record depreciation up to the date of disposal. Debit accumulated depreciation, credit the assets account. Let me say that in a much more simple manner when we get there. Your journal entry, Derek, is always going to be the same. When you sell a fixed asset, it's always going to be a debit to cash, a debit to accumulated depreciation, a credit to the original cost of the asset, and the difference is going to be a gain or a loss on that disposal, okay? So if you have that 4-line journal entry in your head, as soon as you start doing your homework, you can write that down, and then just drop the numbers in. It should make it a lot easier. Determine gain or loss on the sale of an asset. Compare the book value with the proceeds received, right? If proceeds exceed the book value, you have a gain. If they're less, you have a loss. But you still have to do that 4-line journal entry because you have to, when you're getting rid of the asset, you have to get rid of the accumulated depreciation, which is sitting there, and you have to get rid of the original cost of the asset, which is sitting on your balance sheet as well. So let's see what we have here. Wright Company sells furniture for $16,000 cash. The original cost was $60,000. And as of January 1st, 22, had accumulated depreciation of $41,000, huh? So the net book value is 19. We have to put 6 more months worth of depreciation into the pool. That's 8,000. And let's see how the calculation looks. There is the journal entry. What I wanted to, that's just to pick up on the depreciation expense, okay? So take a look here now. We have an asset for which we paid $60,000. The accumulated depreciation was $41,000 plus the $8,000 for the first 6 months of the year where we're getting rid of it. So that's 49. The book value is 11. The proceeds were 16, they told us. We have a gain of 5,000. Your journal entry is always going to be a debit to cash, a debit to accumulated depreciation, a credit to the original cost. Those are the 3 keys right there. And you balance the journal entry to see if you have a loss or a gain, okay? And there it is. I would take a look at that journal entry and just stuff it in my brain. It's always going to be a debit to cash, debit to accumulated depreciation, credit to the original cost of the equipment, and then the high man wins. If the debits were higher, like it is here, you have a gain. If it was the other way around, it would have been a loss. Well, instead of selling the office furniture for 16, they sold it for 9. So we're going to have the same calculation. This time, it's going to be a loss of $2,000. It's going to be a loss of 2,000. Again, we debited, we got cash at 9,000. We debited the accumulated depreciation. We credited the original cost of the asset. The difference is the gain or loss. In this case, it's a $2,000 loss. We could just retire a fixed asset, Derek. We just get rid of it. No cash involved. No cash involved. Well, the loss is going to be whatever the book value was. You're not going to have a gain on retiring it, but you will have a loss. So you're going to debit accumulated depreciation. You're going to credit the original cost of the asset, and the difference is going to be the loss. So we have an old truck. It costs $30,000. It had accumulated depreciation of 16. Assume 2 different scenarios. One, we sold the truck for 17,000 cash. Well, that's easy. The truck cost us 30. The accumulated depreciation is 16. That means the book value is 14. We sold it for 17. We have a $3,000 gain. On the other hand, if we simply retired it, we would have a $14,000 loss. So there's the one with the $3,000 gain. And there's our loss of 14,000 by just retiring the truck, okay? So there's a lot in this chapter. Let's talk about intangible assets. Intangible, you can't touch them. They're not physical. You can't see them. You can't touch them. These are patents, goodwill, trademarks, copyrights, intellectual property, franchise fees. These are all intangible assets with rules to account for them. And like I said, patents, copyrights, trademarks, goodwill, these are your intangible assets. And they have to be amortized. You depreciate fixed assets, physical assets, you amortize intangible assets, and you deplete natural resources. Accounting for intangibles. They have a limited life, and you have to amortize them to expense. You credit the asset or accumulated amortization. And then you have indefinite life intangibles. Those you don't touch at all. Goodwill is a good example of that. Patents. Patents have a 20-year life. We know what a patent is. You invented a product and you went and got a patent from the Washington, D.C. And that patent gives you the exclusive right to profit from that product. You're the only one allowed to make it and sell it. Now, you might sell the patent to somebody else and cash in that way, but to capitalize the cost of purchasing a patent over its 25 years. So you're going to capitalize the cost of purchasing a patent and amortize over its 20-year life or its useful life if it's shorter. A patent has a life of 20 years, but if your patent is for a product that has a product life of 10, then you'd have to do it under 10 years. Any cost in research and development, that's what R&D means, any research and development cost in developing a patent has been expensed, Legal fees incurred to defend a patent are capitalized to the patent account. And we've probably heard that cliche, there's a patent war going on. Amortizing a patent. National Labs purchased a patent at a cost of $60,000. It estimates the useful life to be 8 years. Prepare the journal entry to record the patent for the 6 months ended December 31st. So they paid $60,000. Divide by 8, the depreciable base is $7,500. Divide by 2, you get $3,750. Okay. By the way, the only people who have a patent on their balance sheet are companies who bought the patent from somebody else. The patent developer owns the patent but does not put patent onto its balance sheet, okay? And the reason for that is all of the prior years and years of research and development went into expense, and they got the huge tax benefit that way. R&D costs, they're all expensed. Copyrights gives the owner exclusive right to reproduce and sell a book or magazine article, granted for the life of the creator plus 70 years. Wow. Capitalized costs of acquiring and defending, amortized to expense over useful life. So anybody can go and reproduce Moby Dick. Herman Melville died well over 70 years ago. So there's no copyright on that. So anybody can put together the book Moby Dick and try to sell it. Trademarks, jingles, a phrase, Coca-Cola, Big Mac, the McDonald's arches. That's an example of a trademark. And these have a 20-year renewal life, and you capitalize them just like anything else. Franchises, Subway, McDonald's, Marriott. Franchise, it's a license with a limited life that should be amortized to expense over the life of the franchise. If the franchise has an indefinite life, you can't amortize. And by the way, Derek, that's true about anything in the world of intangible assets. If you do not know what the life is, you cannot amortize. It's just going to sit there at the original cost. Goodwill, we're going to talk about this, I think, in a little bit. Goodwill is the excess of what you paid for a company over the fair market value acquired over the purchase price. In other words, I have a business, and my business has a net worth of $1 million. And that includes $200,000 in fixed assets. You looked at my fixed assets and you realize my fixed assets are now worth more than 200. They're worth, say, 700 or 500 more. So the fair market value of my business for you is $1.5 million. It went from 1 million to 1.5 million when you raised the value of the assets by $500,000. That's $1.5 million. If you then pay me 1.7 million for my company, the difference of 200,000 is called goodwill. Internally created goodwill should not be capitalized. And then they just give us some concepts to look at here. What's amortization, intangible? And tell you what's a copyright, what's a franchise? Research and development costs. I think this is our last learning objective. Discuss how long-lived assets are reported and analyzed. Well, here's what they're going to look like on the balance sheet. So get a good look at this. After your current assets, you're going to come to your fixed assets. And the heading is almost always property, plant, and equipment. Land always comes first. Land comes first. Then you have buildings, less accumulated depreciation. Then you might have vehicles, less accumulated depreciation. Then you might have equipment, less accumulated depreciation like you see here. And then you come up with a total net book value of 11,270 for all of the plant, property, and equipment. Your intangibles are all patents, trademarks, goodwill. Notice you don't see accumulated patents because you just credit the patents and trademark and goodwill directly. Okay, so that's a pretty simple rendering of how it looks on your balance sheet. And then there's a couple of metrics we're going to talk about. Net income divided by total assets, average total assets. Average total assets, whatever the assets were at the beginning of the year, plus what they were at the end of the year, divided by 2. We're going to take that number and divide it into the net income. And JetBlue Airways in 2017 had a 12% return on assets. The year before it was 8.4. Southwest does a little bit better. They get 14.4. And this tells us the amount of net income generated by every dollar of sales. what JetBlue is saying here is for every dollar they invest in an asset, they're getting back 12 cents. So that's a 12% return. Now we're talking about the asset turnover. Again, we're taking the average total, we're taking the average total assets, but this time we're dividing them into the net sales divided by total assets. And you get a turnover here of 0.73 and 74 for JetBlue Airways. Southwest has a little better turnover of 0.92. You would divide those into 365 to get the days, okay? And take a look at this. This is the ultimate ROA, return on asset calculation. If you take the profit margin, net income divided by net sales, which is the profit margin, you take the asset turnover, which is net sales divided by average total assets, you multiply them out, you're going to end up with net income over average total assets, and that's going to be your return. Because when you're doing this, net sales factors out, and you're left with net income over average total assets. So what they're saying here is Southwest was more effective in generating sales from its assets. Southwest was more effective generating sales from its assets, while JetBlue was better with the profit margin, okay? So Southwest overall has a better return on assets than JetBlue does by about 1.5 points. Asset turnover, company reported net income 180, net sales had total assets of 460. We're going to take the net sales divided by the average inventory and come up with our 0.84. Compute periodic depreciation using the declining balance method and units of activity, previously illustrated in objective 2. That's the whole objective, huh? Learning objective 6 is just one page. Go back to objective 2. And now we get into the difference between GAAP and the international financial system. And again, I'm not going to really get into this. The only thing I'm going to suggest is read it, because you might find it interesting. So just read through it. Include it in your summaries. Make notes, few notes of the summary. And I would concentrate on the differences as opposed to the similarities, because the differences are a lot fewer. So IRS uses the term residual value instead of salvage. And the international, you can revalue assets to fair values. So just think in terms of the differences, okay? And there we go. So that is a glance at Chapter 9. I hope it was helpful, Derek. I'm having trouble hearing you, Derek, so I won't. Can you say hi? I just want to see if I can hear you.
Can you hear me better now?
Now I can hear you. Yeah. You got any questions?
I had some headphones in. I don't think they were working.
Okay.
Thank you for going over that. That was super helpful. And then I noticed yesterday, I just want to mention this because we're talking right now, that the first FSA assignment was sent back, and then you said that I didn't have my thing on there, so I checked it and I resubmitted it right when I saw it, because I had two assignments in my Google Docs that were named the same thing, and one of them was.
Okay. Will it be up there now for me to look at?
Yeah, it's in there.
Okay. Yeah, I figured it was something like that. So that's good. I'm glad you hooked up with us. I'm glad we're back on schedule, huh?
Yeah, thank you. Appreciate it. See you on Thursday.
Okay, well, you have a good one, Derek. We'll see you again on Thursday, okay?
Yeah, you too.
Okay, you take care. Bye-bye. And that will do it for today, ladies and gentlemen. Another wonderful lecture in the world of financial accounting.